Stocks started today up thanks to better than expected earnings from major banks and strong revenue forecasts from leading tech firms, but they are now trading lower thanks to recent escalations in the U.S.-China trade war. Now, despite the market optimism, my next guest believes that the U.S. economy is still in a precarious situation. Let's welcome Peter Berezin, Chief Global Investment Strategist at BCA Research. And Peter, thanks very much for joining us.
Good to be on.
Now, you talk about the U.S. economy being on a knife edge and the chance of a recession about in the next 12 months, about 50%. What's driving that cautious, shall we say, cautious pessimism? I don't want to say pessimism, but caution. And you got a chart that kind of helps drive this home. We can bring that up too if you want to have a look at that and talk about it. The chart we have up, Peter, is that one you had about U.S. employment falling outside of the healthcare industry, the healthcare sector,
right.
And
Okay.
that you say is a good indicator.
Well, I mean, it tells us that employment outside of healthcare is shrinking. Now, a lot of people want to chalk that up to slower labor force growth. And of course, that's part of the story. But the thing is, if it were all about supply, you wouldn't expect to see job growth in the one sector where there really are significant supply constraints, healthcare. The fact of the matter is that job openings are still falling. Certainly, if you look at real-time data sources, they've been declining now pretty consistently, which is telling me that labor demand is falling more quickly than labor supply. And unfortunately, unlike what was the case a few years ago, we don't have a lot of insulation around the labor market. If labor demand continues to weaken, we're going to start to see a meaningful increase in unemployment.
And what other concerns do you have right now that you're looking at the possibility of a recession?
Well, the housing market is really struggling. That historically has been the most leading part of the economy. Building permits at our 5-year low. New home inventories are the highest level since 2009. And home prices, if you look at the Case-Shiller index, they've been falling month over month for 5 straight months now. So that's certainly a source of concern. And I would also say that the durability of this AI boom very much is in question. That's really the one plank that's supporting the economy. If that goes, then we're heading into a recession.
It is a large percentage, and we're starting to see some people starting to sell off a little bit, take some profit.
Indeed, indeed. And I think investors are beginning to worry about whether all this CapEx will actually generate enough cash flow to cover the cost. Free cash flow amongst the hyperscalers is actually shrinking, even though their operating or earnings are going up. Because they're spending so much on CapEx, their cash flows are deteriorating. That's what happened at the end of the dot-com period when the telecoms began to suffer deteriorating cash flows. Could happen again with some of these AI companies.
And the tech earnings are coming up. Any concerns that what might you think if the tech earnings, what numbers might cause a little bit of a cascade of people starting to sell even more?
I think guidance is going to be really critical here. Investors have baked in incredible amount of growth for these companies, and they have to start delivering real profits on top of what they've already delivered. And keep in mind that right now you've got a bit of a shell game going on. When NVIDIA sells a chip, that's a profit for NVIDIA. But if Microsoft buys that chip, it's not a cost to Microsoft, it's CapEx. And the problem is that unless that CapEx generates a lot of revenue down the road, it's going to be written off. And that's going to cause real problems for profits and for the stocks.
And are there sectors within tech that are more worrisome than others?
Well, I think anything linked to AI is vulnerable. Anything linked to the whole quantum computing realm, that's extremely speculative and very vulnerable. In fact, we're seeing a sell-off today. So basically, the stuff that is extremely expensive by conventional valuation measures, that's what's most vulnerable at the moment.
And right now, you're sitting underweight in equities for a 12-month horizon. What's your plans for the next while? Are you going to stay there?
I think so. I think so. I mean, the fact of the matter is this. On a P basis, the U.S. stock market is as expensive as it's been any time since the dot-com bubble. If you look at a price to sales basis, the stock market is actually much more expensive than it was back then. So valuations are not your friend right now. And as they say, usually stocks take the staircase up and the elevator down. We have a lot of room to go down if some of the positive parts of the macro backdrop begin to break apart. And I suspect that will happen as the labor market deteriorates further.
And so where are you looking right now then?
I would rather be in the more defensive parts of the stock market, healthcare, staples. They haven't done well this year. At least in relative terms, they should outperform. I'd be moving more money into bonds. The fact of the matter is that if unemployment rises, inflationary pressures will abate. The Fed will cut rates more than what's currently priced in. That'll be good for bonds. And lastly, I'm sticking with gold. It's expensive. I'm a value investor, so when I look at gold prices where they are, I'm not exactly comforted. But I think we're still in the middle innings of a secular bull market in gold, driven by central bank bond buying and increasing retail interest.
Could this be the new normal for gold? We're sitting, I think, at about a little over 4,200 right now. It's over 4,300 now. Or will there be a pullback, do you think, a little bit?
I mean, it's never the new normal. At some point, gold prices will go down. The question is when. If you look at the amount of gold held in U.S. listed ETFs, like the GLD, it's still less than where it was in 2022. So the retail money is just now starting to flow in. Eventually, this will end in tears. It always does. But gold could go substantially higher before that happens.
Okay, just one last quick question with the gold tied in, of course, the U.S. dollar. Your thoughts on that?
I think the US dollar is in the midst of a structural bear market. It remains quite expensive relative to conventional fair value measures such as purchasing power parity exchange rates. The US has accumulated a lot of debt over the years because it's been running these large current account deficits. With rates now higher than where they were a few years ago, the US is going to have to start paying more on that debt as the shorter term, lower yielding debt gets rolled over for higher yielding debt. That's going to put downward pressure on the balance of payments. And finally, if the whole AI story begins to fizzle, a lot of that money that has come into the US market from abroad, tick flows have been very, very strong into equities. That money will come back out and the dollar will weaken.
Okay. Peter, thank you very much for joining us today.
Thank you.
Peter Berezin is Chief Global Investment Strategist at BCA Research.